Hello friends, today we will go through main points of insurance. This will help to understand insurance and prepare for IRDA exam. This is part 1. So let's go through all points. 1. What is insurance? Insurance is a legal contract that provides financial protection to individuals or entities against uncertain losses or events. The person or business pays a premium to an insurance company in return for a promise of compensation in case of a covered loss. In life insurance, it provides a lump sum to the nominee upon the insured person's death. Insurance converts uncertainty into certainty and helps maintain financial stability. It is based on risk pooling and transfer of risk from the insured to the insurer. Example: Rahul buys a life insurance policy of 10 lakh rupees. If he dies during the policy term, his wife, nominee, gets 10 lakh rupees from the insurer. Need for life insurance. Life insurance is essential because it provides financial support to a family in case of the breadwinner's sudden death. It covers debts, education expenses, daily needs, and ensures peace of mind. Life insurance also encourages savings and long-term financial planning. It can be used for retirement, tax saving, or wealth creation through savings-linked plans. It is particularly vital in households where one income supports many. Example: Seema's husband died in an accident. Thanks to his life insurance policy of 15 lakh rupees, her children's education and home expenses were covered. Principles of insurance. Every insurance contract is built on key principles. Number 1. Utmost good faith, complete honesty in disclosing material facts. Number 2. Insurable interest, financial or emotional interest in the insured subject. Number 3. Indemnity, compensation only for actual loss, not profit, in general insurance. Number 4. Contribution in case of multiple insurers, all share the loss proportionately. Number 5. Subrogation right of insurer to claim from third party after settling the claim. And number 6. Proximate cause, the closest direct cause of loss. Most good faith. This principle requires both the insurer and insured to be completely truthful and honest. The insured must disclose all material facts, like illness, smoking habits, occupation risks, etc., in the proposal form. If facts are concealed or misrepresented, the insurer may reject the claim or cancel the policy. Example: Suresh hid his heart condition while buying life insurance. When he died of cardiac arrest, the insurer denied the claim on grounds of misrepresentation. Insurable interest. Insurable interest exists when the policyholder has a financial or emotional loss if the insured event occurs. It is a legal requirement in insurance contracts. For life insurance, insurable interest must exist at the time of policy inception. Who can have insurable interest? Husband, wife, parent, child, employer, employee, creditor, debtor. Example: a wife can buy insurance for her husband, but a friend cannot unless there is a financial dependency. Now, let's see types of life insurance policies. First type is term insurance, pure risk cover, no maturity value. Second, whole life covers till death, claim payable on death only. Third, endowment policy combines savings, jod life cover, maturity or death benefit. Fourth, money back, periodic returns during policy term. Fifth, ULIPS life cover, jod market linked investment. Sixth, annuity, pension plans, regular income after retirement. Now, let's see what is term insurance or pure protection plan. Term insurance or pure protection plan is the most basic and affordable form of life insurance. It provides only death benefit, no maturity value. Ideal for individuals with family responsibilities. It helps ensure the family's financial future is secure if the policyholder dies early. For example, Anuj pays 10,000 rupees for a term insurance of 1 crore rupees. If he survives 30 years, he gets nothing. If he dies during the term, his family gets 1 crore rupees. What is whole life policy? Whole life plan offers life cover till death, often up to age 99 or whole life. Premiums may be limited term or throughout life. The sum assured is paid on death, not before. For example, Meera buys a 20 lakh rupees whole life policy. She pays premiums till age 60. She dies at age 83, her family receives 20 lakh rupees. What is endowment policy? An endowment policy offers dual benefit. If the policyholder survives till maturity, he gets the maturity amount. If he dies earlier, nominee gets death benefit. Good for long-term savings with moderate risk. For example, Ravi buys a 10 lakh rupees, 20-year endowment policy. If he dies in year 10, his nominee gets 10 rupees L-Jor bonuses. If he survives 20 years, he gets the full maturity value. What is ULIP, that is, Unit Linked Insurance Plan? ULIP is a combination of investment and life insurance. The premium is partly invested in equity, debt funds and partly used for life cover. Returns are market linked. Charges include fund management fees, allocation charges, etc. For example, Shweta pays 1 lakh rupees into AULIP. 85,000 rupees goes into mutual fund style investments. Value at maturity depends on market performance. Proposal form. A proposal form is the application document filled by the proposer to purchase a life insurance policy. It includes personal details, age, occupation, income, medical history, nominee information, and policy preferences. This form is a legal document and forms the basis of the contract. It must be filled with utmost honesty. Any false or incomplete declaration can lead to claim rejection. Insurance companies assess the risk based on the data in this form. For example, Aman forgot to mention his asthma in the proposal form. Later, his claim was denied after his death due to respiratory issues. Premium meaning and modes. Premium is the amount paid by the policyholder to the insurer to keep the policy active. It can be paid monthly, quarterly, half-yearly, yearly, or as a single lump sum. The amount depends on age, sum assured, policy term, and health. Regular payment ensures policy benefits and avoids lapse. Example, Priya chooses a 5 lakh rupees endowment plan with a 20-year term. She opts for a half-yearly premium of 7,000 rupees to manage cash flow better. Now let's understand risk and premium rating. Risk refers to the possibility of loss or death. Higher the risk, higher the premium. Insurers rate individuals as standard, substandard, or preferred based on age, health, occupation, and habits like smoking. Underwriting helps decide premium rate. Like for example, Rakesh, a 45-year-old smoker, pays 15,000 rupees for a term plan, while his non-smoker colleague of the same age pays only 9,000 rupees. What is grace period? Grace period is the extra time allowed to pay the due premium without losing policy benefits. For monthly mode, it is 15 days, for other modes, it's 30 days. If the policyholder dies during grace, the claim is valid, minus unpaid premium. For example, if Sanjay's premium due date is the 1st of May and he pays on the 25th of May, his policy remains active, and coverage continues. Policy lapse. What does that mean? If the premium is not paid even within the grace period, the policy lapses. This means all benefits stop, and the policy becomes inactive. In such cases, the insured person is not covered for any risks. However, it may be revived later. For example, Deepa failed to pay her premium even after 30 days of grace period. Her policy lapsed, and her family couldn't claim the benefit after her death. Policy revival. A lapsed policy can be revived within 5 years from the date of first unpaid premium. The policyholder must pay all due premiums with interest and submit health declarations or undergo medical tests. Revival restores original benefits. Example, Akash's policy lapsed due to missed payments during COVID. After 2 years, he paid the dues and revived his policy with a health checkup. Free look period. Free look period allows the policyholder to cancel the policy within 15 days, 30 days if bought online, of receiving it, if not satisfied with terms. Full premium is refunded after minor deductions like medical fees or stamp duty. For example, Komal received her policy and realized it was not what the agent had explained. She cancelled it within 10 days and got her money back. Nomination. Nomination is the act of appointing a person, usually a close family member, to receive the policy benefits in case of death. It can be changed any number of times during the policy term. For example, Rajiv nominated his wife in the policy. After divorce, he changed it to his daughter. At death, the daughter received the benefit. Assignment. Assignment is transferring policy rights to someone else, assignee. This may be done for a loan, temporary assignment, or permanently, absolute assignment. Once assigned, the assignee receives the benefits. For example, Saurabh took a business loan and assigned his 20 lakh rupees policy to the bank. On his death, the bank recovered the loan from claim proceeds. Surrender value. If a policyholder discontinues the policy after paying minimum required premiums, usually 2-3 years, they receive a lump sum known as surrender value. It is less than the total premiums paid. Bonuses may be partially added. For example, Neha paid 60,000 rupees over 3 years in a 20-year policy. She surrendered it and got back 35,000 rupees as surrender value. Loan against policy. Policies with savings component, like endowment, whole life, can be used as collateral for loans. The loan amount depends on surrender value. If loan is not repaid, it is deducted from the death, maturity benefit. Example, Gaurav needed 1 lakh rupees for an emergency. He used his endowment policy and got a loan of 85,000 rupees without much paperwork. Riders in life insurance. Riders are additional covers attached to the base policy for extra premium. Common riders include accidental death benefit, critical illness, waiver of premium, and disability riders, so riders enhance the protection without buying a new policy. For example, Ravi added an accidental death rider to his term plan. When he died in an accident, his nominee received double the sum assured. Claim settlement. When a policyholder dies or the policy matures, a claim is filed. Required documents, claim form, death certificate, policy bond, ID proof, etc. Insurers must settle claims within 30 days of document submission. Delay beyond 30 days invites interest. For example, Rohit's wife submitted the claim papers after his death. The company verified them and paid 25 lakh rupees within 20 days. Thanks for watching part 1 video. Remaining topics are covered in part 2. Also check quiz for exam practice. And yes, don't forget to like, share and subscribe this channel.